My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer. My friends, I'm just trying to make a little money. My job is not just to entertain, but to educate and teach you. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. I know bonds are the most boring subject imaginable, but the bond market matters. Bond yields have been going up like mad ever since the Fed cut rates last month. The opposite of what you'd expect, and the velocity of the move is so fast that the stock market can't seem to find footing. Make no mistake, bonds are behind today's ugly action in the big caps. Dow losing 344 points, the S&P declining 0.18%, and the Nasdaq actually did advance 0.27%. I won't say bonds are the only thing that matters. Others do that. That's not true, though. And there are plenty of people who already give you that bogus argument. I hear them all day. So do you. It's absurd. The stock market has had a fabulous run, even as bond yields have crept up almost the entire time. They love to ignore that glaring fact, the bears. Every day is Groundhog Day for them. They see interest rates go up higher, so they panic themselves, and they are trying to panic us. But we will not be panicked. What are the bond bears really afraid of? Let's go down the list. First, the bond bears always like to use long-term interest rates, the ones set by the bond market, as a cudgel to hammer the Fed. To them, the Fed is the be-all and end-all because Fed watching, guess what? It requires no homework whatsoever. It's not like they're figuring out if Boeing has the requisite cash flow to be in on the underwriting or if ASML is really indicative of the state of the semiconductor business. If we were talking about the NFL, these are people who've never heard of the spread. They're only picking winners on the money line, not winners giving points. I think they're ridiculous in the lack of nuance. Rates higher, blame the Fed. Rates lower, take credit yourself. But here's the simple truth. Did the Fed need to do a double rate cut, moving 50 basis points and not 25? Yes. Yes, they had to do it. If they wanted to be sure that the proverbial plane didn't crash, it was the best way to keep alive the promise of a soft landing, no landing, or a quick touchdown and fill up. So no, Jay Powell's not a dunce or a softy. He's just doing his job responsibly. And these constant naysayers will be wrong once again. They really bother me. But because bears in the peanut gallery are never held accountable, no one will remember it. If you're them. Second, a double rate cut is supposed to be inflationary, and that's what the bond market's saying. Bonds are trading like the first cut has already reignited inflation, and that you're seeing that reflected in higher long rates. To which I say, whoa, slow down. Do you really think the reverberation from a rate cut is really that fast? Absolutely not. In fact, if long rates, meaning the 30-year, have gone up enough, what they end up doing is actually being anti-inflationary. The worst part of the inflation cycle the one that needs to be slain is housing, and higher long rates will cause housing to cool again. Not only will mortgage rates be higher, but there'll be fewer homes built. All bad for the economy. We're going to have more on this later, but heavily anti-inflationary. So if you see bond yields going up and you want to blame the Fed for stoking too much economic activity, boy, you got a painful lack of knowledge. If this is really a problem, it's a problem the bond market can solve by itself. Finally, pathetic toy bears will say that stocks can't possibly go higher if rates get hit. Higher rates, stocks must go down. I don't know. How about a 4.75% 30-year treasury? If we get to that, that's about a quarter point from here. You know what? They're going to pick that line. You're going to hear that over and over again. That's an arbitrary line, and that's a line in the sand, and they're going to stick with it. And they're going to tell you the market's going to either go down big or crash if we pass that. Now, I am not oblivious to any of this, but I come back and I say, well, wait a second. Here's what you need to know. We are nowhere near the point where the bull can be slain by higher, longer rates. Nowhere. Stocks have soared with bond yields at these levels before. In fact, they've soared with the 30-year 5%. They've soared with the 30-year at 6%. So let's stop it with the Jeremiah acts. All they do is scare people out of some very good stocks. The stocks are companies that are doing quite well. Hey, that's why you sold NVIDIA. That's why you sold Apple. What a travesty. So why do the bond bears insist on mauling us like this? Well, some of it's related to what I call the hedge fund playbook that says when bond yields go up, you should sell stocks because historically, higher rates translate to lower stock prices. That's true, in part because the higher rates are a magnet for lower stocks. But you know what matters, what's missing from this equation? Things have changed. We have so much money coming into the market via index funds, and all that money means we don't get the same intensity of selling even when the bond market goes against us. The big buybacks, the S&P 500 index money serve as a 1-2 punch against the bears because they create a temporary stock shortage. Think about this. Buybacks take stock out of the market. S&P 500 index fund money is passive. It's sticky. They have the same impact as taking stock out of the market because index fund money rarely gets taken back. There are not a lot of sellers of index funds. Buyers, buyers, buyers. Buy. So the automatic sellers that we're used to seeing when bond yields tick higher tend not to have as much impact. Have you noticed that we're frequently down at the opening and then we rally like the NASDAQ this morning? That's because future sellers start the day betting against stocks, and when the real sellers don't materialize, they have to cover their short bets, driving the averages ever higher. It is literally a virtuous circle of short sellers not acquitted by actual sellers, which then begets buyers. This is a pattern no one is talking about, but it rings true. It rings true almost every day with some part of the market. As I said, today was NASDAQ day. So what can you do? Well, first of all, I have to suggest that you never, ever, ever buy any stock on a day when it is up big, when the stock is up big. Long rates are going higher here because too much economic activity. That's okay. You want economic activity. You don't want J-Powell to be too restrictive and crater the whole economy. When rates go higher, the sellers of the S&P 500 futures, typically short sellers, are emboldened by their Pavlovian instincts to sell. Then they knock stocks down. And that's your chance to buy them, not when they're up, when they knock them down. The great part of this is that you can buy stocks that shouldn't be down, including stocks of companies that just reported strong quarters. As long as you wait, you're likely to get lower prices, and then you can pounce. Now, maybe a lot of this has been in the back of your mind, but you didn't want to say it because the bond bears on air are so erudite, and they make you feel like an idiot. Don't let them do that to you. They're the ones with no understanding of history, not you. In fact, this S&P futures phenomena is new that I just described. It isn't in the algorithms. It is not in the hedge fund playbook. We've never had so much money flow into the market via index funds before and then sit there immobile, as if it's been crunched like a buyback. And we've almost never had so few equity offerings. So there's no new supply of any big amount. Here's the bottom line. It's an extraordinary time for the stock market. I know it's easy to say rates higher, sell stocks, rate lower, buy stocks. The only problem? It's wrong. Gregory in New York. Gregory.
Hey, Jim. Greg here. Thanks for taking my call.
Of course.
First of all, I'd like to say I appreciate all the work you do in the investment club. You and your team,
thank you.
Myself, my brother, my father were all members.
Thank you, man. I hope you like the Sunday pieces I do. They interrupt my football time. Actually, no, they interrupt my lifetime. But that's all right. I do it for you. What's going on?
So I want to talk about SLB. They ticked lower last week on a revenue miss. However, the stock overall is still trading at less than 11 times earnings. You know, that being said, there's a lot of uncertainty concerning the macroeconomic environment around it. What's your outlook on the stock, and is it a buy?
I like SLB. I actually like the conference call. They've really de-risked it. They told you all the things that are going wrong, none of the things that are going right. And I don't want to jinx anything, but I don't want to. But, you know, if there's a Middle East flare-up, that stock is going to hit. That $42 stock is going to be at 48, and you're going to make money pronto. I agree with you, and thank you for the kind words. Let's go to Ayush in New York. Ayush.
Hi, Jim. Thanks for my call. And a big booyah to you and your team.
Booyah right back at you from the team.
I appreciate that. I've been following a stock that's consistently beaten earnings, grown its membership base, diversified its financial products, and strengthened its personal loan capabilities recently. Despite its strong performance, it's still down about 60% from its all-time high. Given these fundamentals, how do you think I should trade SoFi?
Oh, just to the long side. They just got some new big money. They've got big backers. They've got a great CEO. The stock is breaking out. The short's going to have to cover. SoFi is a buy. I know it's easy to say that higher rates mean you should sell stocks, but right now that would be wrong. It's an extraordinary time for this market. Buybacks, S&P money, yes, for real. They have money tonight. Banco Santander just launched a milestone U.S. expansion in digital banking, and it kicked off by ringing the closing bell. I'm hearing more about it in the news from the company's top brass. You'll want to hear that story. Plus, is the rally in home builders hit its roof, or can the group actually keep heading higher after what I just described? I'm going off charts to find out, and telling you which stocks could keep leading the charge. Then American Express fell on Friday's beat and raised quarter, but is it just yet another buying opportunity? I'm tearing through the quarter and giving you my take, so stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Whenever earnings season kicks off, we like to focus on the big domestic banks that report first. But often we forget that some of the largest banks in the world are based overseas. Take Banco Santander, the massive Spanish bank that's a huge global player with rapidly growing presence here in America. Just today, they brought Open Bank, Europe's largest purely digital bank by deposits, here to the U.S. and celebrated the occasion by ringing the closing bell right on the New York Stock Exchange, right up there. So let's take a closer look with Anna Boutine. She's the executive chair of Banco Santander. Ms. Boutine, welcome back to Mad Money.
It's great to be here.
Anna, this is a big deal, this Open Bank, because from what we've been able to check, this is the best rate that anybody is offering in this country. So tell our viewers about it.
So we're very excited about the launch of Open Bank. It's been very successful in Europe, as you said. And, you know, we're launching today what I believe is the best high-yield savings account in America. It's fast, it's simple, very competitive rate, and very important, it's backed by the trust of a bank that has 168 million customers globally.
Now, I think people should recognize that you are huge in, of course, Spain, but UK, Latin America. You have a gigantic footprint, much bigger than our banks in America.
Well, we are in Europe and the Americas. We pride ourselves that we have both global scale and in-market scale. So those are the two things that make us different, plus diversification. And yes, in America, we believe we have a lot to add to the U.S. consumer.
Now, you're a dominant player in auto loans here, and people may not know that, but that's a franchise that actually is much coveted by others that you really have a stranglehold on.
We're the fifth largest auto lender in the U.S., the number one in Europe, number one in LATAM, and this high-yield savings account makes us more profitable because we're replacing wholesale funding. So that's the reason we can offer you a great rate with a great customer experience, and I think that's the unique combination.
But when you're here, I got to talk global. And one of the things that is incredible in your annual, you have been talking about how Latin America turns out to be a much better market than people realize. Brazil making some incredible interest. Obviously, Argentina, we can asterisk that. But you recognize that there's a burgeoning middle class, and you are opening a huge number of customer accounts there.
Well, I mean, just Mexico and Brazil, 350 million people. Half of the people in Latin America don't have a bank account. Okay, so the potential is huge. Yes, you need to understand the market, but as I always say, the lows are always higher.
Right.
And, you know, we're doing very well.
Okay, so have you got to meet President Sheinbaum?
I have met her when she was the mayor of Mexico City, yes.
And do you feel, I mean, I know that, in full disclosure, we have an account with you in Mexico, but that it seems like you're one of the largest, but that you could end up being the largest at this trajectory.
So in Mexico, depends on the customer segment. We are number two, number three.
Right.
We're growing very well, and, you know, we are investing in Mexico. We believe Mexico has huge upside. Not just the nearshoring, you know, very young demographics, again, very unbanked country. So we're doing very well.
Now, if you wanted to, you are not constricted. You could buy other banks in the United States, too, if you wanted to.
We believe we have a very, very attractive, organic, profitable growth strategy.
Okay, so tell me about what's going on in Europe with rates versus here and how you decide where to put your capital.
So we have been putting more capital in the Americas, you know, reducing Europe for the last few years. However, Europe is a very different story north from south. So the countries where we are present, which are Spain, Portugal, Poland, are growing much faster than the north. And Europe, you know, has a lot of upside. At least now we have a good diagnosis of what is not working. The Draghi report was incredibly important. And now we just need to get on with it and, you know, put in place structural reforms, make sure that we can compete. So it's not just about regulation that makes banks safer or that protects consumers. The big elephant in the room is lack of growth, not just in Europe, but the world. We need to grow faster.
Now, you are also doing it with a capital light model. That is very different from most of our banks. To me, that would mean that you have, I say, less risk and more reward.
Well, again, Santander is diversified by global businesses. We're really a community bank in many different countries, right? We're local in Mexico, in Brazil, in the UK, in Spain, in the US, and that is really our model. 97% of our revenues, and we grew 10% our revenues year on year as of June, are customer related. We do not do market making. It's 3% of our top line.
But at the same time, I mean, you are really expanding your commercial, industrial, your corporate bank, wealth management. I see that at 6%, but I think that could grow aggressively. And payments must be a terrific business for you, 9%. But given your worldwide nature, that could be a double someday.
So payments, it's at the core of our consumer relationship.
Right.
So we're building a global API, right, connection between all our banks. So you will be able to do instant payments amongst all the Santander countries. So if you have an account in Mexico, an account in the US, by the end of 25, we're launching Open Bank in the US and in Mexico. By the end of 25, this will be a full-service digital bank in the US. And we'll be connecting the US and Mexico through Santander Bank. So you will be able to transfer and operate across the two countries with one account.
That's not possible from any of our American banks. We can't do that.
No, but we are.
Do you tell me that I can directly bank in the United States and Mexico with Santander?
As of the end of 25, yes.
All right, that's not. Because you have the edge. You have the edge on American banks, which do not let me do that.
So what we have built, Jim, and as has been said, this is an overnight success, 10 years in the making. We have built our own back and front cloud-native tech stack. It's ours. It's been deployed in the United States in a highly regulated bank with the Know Your Customer and all the regulation that you're aware of. We're doing the same in Mexico. This is going to be very unique.
What a tremendous
And this is something which is coming to the United States by the end of 25.
You're an interesting banker. When I ask people about you, what they say? You're the savviest cyber security banker in the world. So what was your interest in doing that?
Many years ago when I was running Banesto, I realized that in the digital age, we will only be, as a bank, as good as our technology and our people. We need the best technology, and for that, we need the best people to build that technology. And that is what we've done. In our core banking, we've partnered with Google. So we are now, I told you this last time, I believe, we're marketing to other banks. So, yes, I believe that, the customer experience that when you go online is only as good as your tech. And we need the best people to build that.
Well, what can I say? Once again, 5.25, and you California people, Florida people, this is open to you.
And very soon here, too.
And very soon here?
In footprint.
Okay.
Yes.
Then I will wait.
Yes.
To transfer my money from a bank that you once worked at.
Don't tell me the name because
I don't have to.
I think it's a very good bank.
I know, and you have great relations with all the banks.
Yes.
I know that, both personally and with the people who run the banks. That's Ana Boutsin. She's executive chairman of Banco Santander. It's a $5 stock. It has a good yield. They buy back a ton of stock. I think it's a terrific investment. Mad Money's back after the break.
Coming up, time to build a position in the home builders? Cramer hammers out whether the group is built on a strong foundation. Next.
We need to talk about the quiet rally in the home builders. Here's a group that rallied almost 68% last year as measured by the iShares U.S. Home Construction ETF. And it's up another 23% this year, beating both the S&P 500 and the NASDAQ 100. Last year, the home builders made fortunes despite high mortgage rates because we have a massive housing shortage in this country, and the home builders have been very disciplined about adding new capacity. They don't want to build a bunch of new houses only for the economy to roll over. It costs them a fortune. Now, though, the Fed's starting to cut interest rates, and the home builders are the most direct beneficiaries of those rate cuts. They should, in theory, translate into lower mortgage rates. And the lower mortgage rates go, the more demand there will be for housing. Even another 100 basis points of rate cuts could help fuel the housing bull market for years to come. So can this rally in the home builders continue? To answer that question, we're going off the charts with the help of old friend Bob Lang, the founder of ExplosiveOptions.net and the author of Know Your Options. When Lang looks at the home builders, oh boy, he sure sees a lot more upside. At the end of the day, there's two props to the housing rally. On the one hand, even as we've been producing more homes, we simply haven't been able to keep up with the demands of a continually rising population in this country. Even if they wanted to, the home builders can't build enough new units fast enough because of state and local regulations of the environment and that make it difficult to construct anything. But at the same time, the home builders don't really want to build. Not with long rates creeping relentlessly higher. Isn't that what we talked about at the top of the show? This is something I've been thinking about before. Lang has said it's very important, so this should not be new to you. Basically, the home builders all got burned by the Great Recession. In the run-up to the financial crisis, they recklessly overbuilt and relied on all sorts of teaser mortgages to artificially bolster demand. Then that demand evaporated, housing prices crashed, and the homeowners were left holding the bag with acres upon acres of unsold inventory. Even with the Fed cutting interest rates to near zero, it took many years for the homebuilders to bounce back from that. It wasn't until 2011 that the major homebuilders got their act together, but it's still seared into their memory, and they don't want to go through something like that again. Now, it's 16 years since that financial crisis, and the people running the home builders are a lot more cautious about the cyclical nature of the real estate business. They've become much smarter and more conservative in their approach to building new homes, and that's why their stocks could do so well last year, even if it seemed like the macro was very much against them. Today, Lang points out that demand for new homes is robust and supply is still limited, as these builders either can't or won't build enough houses fast enough. That translates into pricing power. Throw in the Fed's new rate cutting cycle, and you've got a recipe for a powerful bull market, regardless of who wins the election in 2 weeks. Hey, but speaking of the election, Lang notes that if we look back during the Trump years, the home builders performed quite well, including a dark period near the start of the pandemic when every stock was being sold. The aforementioned ITB ETF more than doubled during that 4-year stretch, which included even lower mortgage rates that helped the homeowners buy in or simply refinance the previous higher rate loans. How about these last 4 years under the Biden-Harris administration? Again, huge outperformance. The homebuilders have been a top sector since 2021, with Pulte, D.R. Horton, and Toll up staggering amounts, 148% to 215%. The iShares U.S. home construction ETF more than doubled again since Biden's inauguration, putting this group in the top tier of performance. And all this happened during a time of high inflation that was eventually brought down by the Fed's aggressive rate hikes, which are the enemy of real estate. Amazing performance considering the very challenging conditions. This was a history-defying move. So whoever wins the election, Lang's confident that the biggest winners may be the home builders, which is why we need to look at the charts. Let's look at the three best-of-breed operators, Pulte Group, D.R. Horton, and Toll Brothers. Although I would argue Lennar should be there, let's deal with the three that he likes. When you check out the daily chart of Pulte Group, PHM, okay, the stock's made a sharp move higher since July on elevated volume. You can see, look at this. Pretty not bad, huh? For Lang, this is a textbook sign that big institutional money managers are buying it hand over fist. See, there's all this volume. It's not bad. If they're following the hedge fund playbook, which says you need housing exposure when the Fed's getting ready to cut rates. Even though Pulte has reached overbought territory, and you can see overbought, you can see it's just all of these numbers point to way too overbought. It looks like it's rallied too far too fast, right? The buyers are snapping it up on every dip. Lang points out that the moving average convergence line, or the MACD, and that's right here, has recently made a bullish crossover. That's the crossover, but I know Bob from the old days loves those, where the black line goes above the red line, and this is one of the most reliable buy signals in the book. When you look at the Chaikin money flow, a long time since we heard that one, CMF, okay, that's an indicator that shows whether big institutions are buying or selling. It remains positive after a great few months. That's the Chaikin money flow. Plus, Lang likes that Pulte's been making higher highs and higher lows. That's the textbook definition of an uptrend. This is a $140 stock that Lang says could see $200 next year. Nice gain. All right, how about the daily chart of the high-end Toll Brothers? Lang says this is another chart that's in great shape thanks to a series of higher highs and higher lows. There we go again. The MACD just made a bullish crossover here, too. Jeez, these are terrific. Flashy buy sign. The Chaikin money flow that we just reintroduced remains positive. More important, Toll Brothers has had 4 meaningful pullbacks since July, and Lang notes that every one of these dips had to be bought. Toll currently trades at 153. He thinks it could go 200 to 220 next year. We want these moves, don't we? Finally, there's D.R. Horton. According to Lang, the stock's building a base right now, sideways consolidation after a monster move higher. Currently at 186, Horton's had trouble breaking out past the ceiling of resistance at 200. So you can see this is a channel like that. While Horton's also giving you a bullish MACD crossover, right there's the MACD crossover, Lang notes that it's happening at a lower level and the moving averages are flattening out. So the uptrend is cooling down. However, the Chaikin money flow, still going strong. Many big institutions still want it, and that's why Lang is betting that Horton's simply catching his breath for the stock to escalate higher. After some more sideways action, he thinks this thing could take off next year. $186 stock, maybe $250, maybe even $275. Wow. Here's the bottom line. The charts interpreted by Bob Lang suggest that the homebuilders have a lot more room to run. Not room to run, but a lot more. His favorites, Pulte Group, Toll Brothers, and D.R. Horton. But especially Pulte. My view, if you don't own a homebuilder at this point in the business cycle, you're probably shooting yourself in the darn foot. Let's take calls. Let's start with Mike in Michigan. Mike.
Hi, Jim. How are you tonight?
I am good, Mike. How about you?
I'm fine, sir. Listened to you for years. Appreciate your knowledge and helped me do quite the good things in life.
Thank you.
Rockwell Automation, what's your perspective on it going forward, sir?
You know, I am not a big fan of Rockwell Automation. However, Honeywell has an automation division that I think is going to be absolutely terrific. And I've got to tell you, they report this week, so I'm kind of sticking my head in the lion's den. They didn't report that great last time, but I genuinely believe that Honeywell is going to have a terrific quarter. And I think that you're going to be in very good shape with that one. Let's go to Bill in Massachusetts. Bill.
Jim, can I just take a minute and thank you and your staff for a phenomenal job? You guys are incredible. In the last 2 years, you've made me so much money. You, your staff, and your family are in my prayers regularly.
Oh, my God. Man, you're too kind. But I will pass everything on to my staff. It's not my staff. It's our staff. I don't ever want to think it's my staff. That's the wrong call. But I just am absolutely thrilled that you said this, and I really appreciate it. Thank you.
And give Jeff and Regina a pat on the back for me. And it was a pleasure meeting you at the annual meeting. It was awesome.
Oh, you were at the meeting. Are you in any of the ads?
What's that?
Are you in any of the ads? You know, we run those ads, those testimonial ads that are so great. Well, anyway, I'm thrilled.
Some of the voice ones I was on, but I haven't done a personal one yet. Yeah. All
right. Well, this just turned out to be, I'm looking at Regina, amounted to be in a personal one, how terrific you are, and I thank you. How can we help?
Jim, about 6 months ago, we talked about server robotics, and I understood by you that it was too early to get into that company. It wasn't making money yet. And looking at the richest man in the world, Elon Musk, and his army of robots, is there anybody that can compete with him?
No, actually no, because he's got 100,000 of the high-end cards made by NVIDIA that are working at a supercomputer pace for him for his robots, and no one else can afford that many. So it's a giant moat that is making so you have to own Tesla if you want to go that way. I want to thank you for those kind comments and pass them on to our staff, and that makes everybody feel great because everyone's working double time here, and I really appreciate it. All right. The charts, as interpreted by old friend Bob Lang, suggest that the home builders have a lot more room to run. I think if you don't own a home builder at this point in the business cycle, I don't know. I know I'm thinking when I saw his charts, maybe I got to make room for one in my charitable trust. Much more mad money yet. I pounded the table on buying the dip in America's Best before, so is history repeating itself after its latest post-earnings slide? I'm telling you where I stand. Plus, what should you make of the activist action in the boardroom? I'm looking at it case by case, fresh off a starboard stake in Kenview. And all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer. For some reason, the market can never figure out how to properly judge the results from American Express. I've lost track of the number of times that I've had to come out here and tell you Wall Street's gotten another Amex quarter wrong. Hey, by the way, that includes last time the company reported in July on the same day as that big CrowdStrike outage. American Express tumbled nearly 3%, and the very next trading day, I told you to buy the dip. It went on to rally from $245 all the way to $286 last Thursday. Buy! Right before the company reported all over again. Unfortunately, I've got to get repetitive here because it happened again. On Friday, American Express delivered another strong quarter, and the market didn't like it, selling the stock down 3.1%. Today, it lost another 2%. So it's now going from 285 and change to 270 and change. Big hit. But after taking a close look at the quarter, I can tell you that once again, this was actually a great set of numbers. Like clockwork, you need to Buy, buy, buy! While American Express reported in-line revenue, their build business, the total spending on their cars, has stabilized at a 6% growth rate. Their total expenses were up 9% year over year, but that was still substantially lower than expected. All told, American Express earned $3.49 per share. The street was looking for $3.30. As for the guidance, management formally trimmed its full-year revenue forecast slightly from 9 to 11%. That's growth, down to just 9% growth. But they also raised their earnings outlook for the second quarter in a row. Last time they were talking about 19 to 23% earnings per share growth. Now it's 23 to 25% growth. That's huge. For the core U.S. consumer business, it looked like the year-over-year growth for each of the company's three demographic buckets. You see far different results. Millennials and Gen Z cardholders are still spending like mad, with build business up 12% year-over-year. Meanwhile, build business for baby boomers and older was flat year over year. Gen X is somewhere in the middle with 4% build business growth in the quarter. More on that a little later. Their international card services division is roaring with build business up 13%. I think there's tremendous opportunity there. Finally, American Express had excellent credit quality numbers, and these should only improve now that the Fed has started cutting rates. Normally, at this point in the business cycle, credit quality becomes problematic. Not this time. The total provision for credit losses was a little lower than expected, largely thanks to fewer write-offs. Delinquencies and write-offs as a percent of loans and receivables are both looking good. Well, then why the heck did the stock sell off on Friday? I think Wall Street doesn't know what to do with Amex's gradual slowdown in revenue growth. They had 13% growth in the third quarter of 2023, and it was just 8% this quarter. They've gone from basically the low double digits to the high single digits over the past year. This isn't so much an issue for the company's current results, but it makes some investors question whether American Express can keep hitting its longer-term targets. A lot of people feel they're too aggressive. They're aiming for double-digit revenue growth and mid-teens earnings growth. In fact, the revenue growth slowdown was the first thing the analysts asked about on the conference call. CEO Steve Squeri explained that it will be hard to generate double-digit revenue growth without a pickup in build business, meaning higher transaction volumes. However, he also made it clear that even though the revenue growth has slowed, American Express has still been able to put up better and better earnings growth. That earnings strength is the reason why I pounded the table on Amex when they last reported back in July, and I think it's the big reason why the stock was able to surge to new all-time highs after that initial post-earnings sell-off. But for whatever reason, when we get the actual quarterly results, Wall Street only seems to focus on the top line, not the bottom line. Squeri also made some poorly received comments about organic spending growth, which he conceded is not great right now. Not terrible, but not great. Squeri said, I'm going to quote here, I think when you look at the overall spending, organic spending in our customer base is not as robust as it was in a more robust environment, end quote. He goes on to say, though, what our cardholders will do is pull back slightly if they lose any confidence, see any sorts of signs of their own stress, but they will continue to pay their bills. And that's why our credit numbers are so good. You know what? That's a fairly honest, sober assessment of the state of Amex's business right now. But somehow the company's still been able to post amazing earnings numbers, and the environment should get much easier as the Fed cuts rates. So what are the sellers missing then? I've already said my piece on the earnings story, so let me allow to explain the long-term opportunity here, which is that American Express has the potential to grow with its legions of younger cardholders. Remember, they're seeing terrific spending growth from millennials and Gen Z. Younger cardholders are still spending like mad, while older customers are basically flat. But people seem to overlook the fact that this is a very positive indicator for the company's future. See, once American Express lands these younger customers, there's a very good chance that they'll be able to hold on to them for life. As their cardholders become older and more affluent, they can graduate from a green card to a gold card to a platinum card. Hey, by the way, each of these higher tiers comes with not just better benefits, but also higher fees. A platinum card costs almost $700 per year. They're the only player in the space that can get away with charging these fees at scale, in part because the platinum card has such incredible travel benefits, but also because they got great customer service. Beyond the explicit fee revenue, though, you need to keep in mind that younger customers have a higher lifetime value than a Gen X or a baby boomer customer. As Squeri spelled out explicitly in the call, sometimes, I got to tell you, I mean, the analysts either don't seem to understand this or they don't value it very highly, and I think they're wrong. At the end of the day, American Express reported a strong quarter, and its stock still dropped more. It's now dropped more than 5% over the past two sessions in response. And like I tell you, almost every quarter, when the stock sells off like clockwork, I think you're getting a fantastic buying opportunity. Now, the bears are too focused on companies' slower revenue growth, but they're missing the fact that this hasn't prevented American Express from blowing away the earnings estimates. And earnings are the more important metric here. You have to trust me on this, because I've been right, the analysts have been wrong. Bottom line, Don't miss the forest for the trees here. American Express had tremendous success at winning over lots of younger customers who will likely stick with the company for decades to come. And that's the big story here. Not a line or two in the call about softer spending environment right now, which management is handling with aplomb. And if you believe the big story, then like me, you know that this regularly quarterly pullback is your chance to buy American Express hand over fist. Then money's back after the break.
Coming up, lightning doesn't just strike twice in Cramerica.
Booyah, Jimmy Chill. Booyah, booyah, booyah.
Thanks for taking my call.
It strikes every day. Cramer is back in a flash with your questions. Next.
It's time for the lightning round. Cramer, where Rob Coles on CNBC talks to buy, sell, doing the close up. Let me explain this now. And then the lightning round is over. Are you ready, Ski? That's time for the lightning round. Let's start with Jerry in New York. Jerry.
Hey, Jim, how you doing? 11th time caller here.
11th time? That may be a new record. I don't know. But Dave in Illinois could beat you. What's going on?
A while ago, you and I talked about Cheniere Energy, symbol LNG. Is it a good time to buy it?
Yeah, natural gas prices low, business high. I would buy LNG, absolutely. I think that is. CQP is good too. That's the analog. But yeah, the stock is up a great deal. But yes, the answer is it's the right time. Let's go to Steve in New Hampshire. Steve.
Jim, booyah.
Booyah to you. Same.
Thanks. Hey, listen, I have a question on, because I'm heavy on VU and QQQ, and I'm looking to diversify into GE Vernova. What are your thoughts, and is there any change?
Okay, GE Vernova is about to report, and my problem is GE Vernova may be one of the situations where it sells off on good news, and I think you are going to get good news because I think the company's doing incredibly well, and Scott Stracek's doing a terrific job. But remember, this is like one of those companies that is a data center magnet. They have nuclear power. They have, let's say, just small nuclear reactors, but that won't be online until 2030. But be aware that they are the way that people are playing the power to the data center. Let's go to James, Massachusetts. James.
Hey, Jim, first-time caller. Thanks for having me on.
Thank you.
We're talking about HubSpot today. I got in around a cost basis of about $600, and I'm having a really hard time figuring out what the fair price of this thing is in the shorter term. It was flying high.
It's really hard. I tell you, it's really, really hard. I mean, it sells a high multiple. I have referred to Salesforce.com, particularly with Agentforce. It doesn't have the growth of the HubSpot, but I think that this HubSpot's playing with fire, frankly, and I do not want to play with fire. Let's go to Jason in Florida. Jason.
Hey, Jim, how are you? Thanks for having me on.
Thank you for calling, Jason.
Hey, I was talking to a buddy of mine, Bean Picker Craig, and he told me about this stock that's been going up steadily for the past month. So I want to know if my buddy Bean Picker Craig is right about IonQ.
That's a parabolic move. You might be in the middle of the parabolic move. That means you got more upside. You might be near the end, and you're going to get clobbered. I cannot recommend that stock on that basis. Let's go to Jake in New York. Jake!
Booyah, Jill Van.
Yeah, man, what's happening?
I'm calling about a hot stock, so not very chill. Help us D-Gens out and tell us the move with this top D-Gen stock. I know my buddy Mike needs some help. They move the lines and set the handicaps. They fuel my live betting addiction. They work with MGM, DraftKings, and FanDuel. I'm talking about Sports Radar, SRAD.
I don't know Sports Radar. I don't know that one. I know every one of those companies you mentioned. I thought it might be one that I also knew, but I do not know Sports Radar. We're going to have to do some work on that. Let's go to Ron in Florida. Ron.
Oh, thanks, Jim. Thanks for taking my call. I really appreciate it.
Of course.
My question to you, Jim, is I'm looking at Vistra, VST, which I'm sure you know very well.
Yes, I do. I mean, this is Extra Energy, which is the same thing as Constellation. And I've got to tell you, they're interchangeable. They have been resting of late. I feel like they're just resting, and then they'll go higher, but I don't know when that's going to happen. Let's go to Rick in Massachusetts. Rick.
Mr. Cramer, thank you for taking my call. Long-time listener, first-time caller.
Excellent.
I'm calling regarding NewScale Power Corporation, ticker SMR.
Yes, again, that's a small-scale nuclear module reactor, and I think that stock is losing. That company's losing a lot of money. You might as well go again with GE Vernova, GEV, because that's something else to fall back on, and you still get the nukes. Let's go to Chris in New York. Chris.
Hi, Mr. Kramer. I had a question about ATS Space Mobile.
Okay, I have felt that company is overvalued. It's a telecommunications company with mobile space. I keep waiting for Starlink to come out, and then I've been more involved. That's the Elon Musk company. I cannot recommend AST Space Mobile. It doesn't make any money. Let's go to Mark in Connecticut, please. Mark.
Hey, Jim. How you doing? Thanks for taking my call.
Of course. Thank you.
I asked about Dexcom.
That last quarter was really terrible. I've got to tell you, new quarter's on the horizon. I frankly can't believe that it could be as bad as the last quarter. And the Kevin Sayer, I think, can deliver. But you know what? I lost conviction after that last quarter. I really did. And that, ladies and gentlemen, the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, forget Yankees versus Dodgers. One of the biggest rivalries these days seems to be activist versus CEO. Cramer tackles the companies in the crosshairs. Next.
Sometimes a broken business is in such bad shape that it's hard to imagine how anyone can fix things. Other times, a sacrificial firing or two is all it takes. That's how I feel when I think about the most aggressive fights between activist investors and existing management right now. The activists love to take heads, but that doesn't always make sense. Tomorrow, Jeff Smith from Starboard Value, a very successful activist firm, will present a paper about how Kenvue may not be moving fast enough to create value. Smith is an incredibly well-informed manager whom I tend to agree with, a guy with a great track record. Kenvue is the recent consumer health spinoff of Johnson & Johnson that hasn't really done anything since becoming independent. Smith wants to see change and will detail his plans to unlock value. Kenvue has its own plans to bring about better numbers, but it really hasn't had a chance to deliver yet. In Kenvue's defense, this great house of brands, I think Band-Aids, Tylenol, Aveeno, Listerine, Neutrogena, was only spun off a little more than a year ago. It hasn't even had a chance to move into its own headquarters yet. But Smith would like to see some alacrity, and that's not yet visible. And he's unhappy about the performance in health and skin and beauty. But you know what? This is where I have a problem with Starboard's view. See, health, beauty, and skincare have been incredibly difficult for everyone of late, including some terrific companies like Procter & Gamble and Estee Lauder and Ulta Beauty. Yes, I think Kenvue should be doing better in social media, and they should be performing better on Amazon. But I say it all in good time. No need to take any heads here, at least not yet. Then there's CVS. Last week, CEO Karen Lynch was fired. Perhaps because of some pressure from Glenview Capital, we don't know. CVS played in the drugstore category, and which is ridiculously difficult if you examine the competition, Rite Aid and Walgreens. It also works in managed care, where Humana, UNH, and Elevance all blew up this quarter. Hard to really blame Lynch if everybody else is blowing up, right? And I think that was the case here. Elliott Management, how about them? They're very unhappy with CEO Bob Jordan's stewardship over at Southwest Air, symbol LUV. And they're seeking some board seats, ostensibly to help the company, but potentially remove Jordan. Of course, they think Jordan is helping the company, but they think removing him is helping the company. Southwest, though, is responding with some good ideas, and they think he's helping the company. Many of the ideas are Elliott's, frankly, but it might not be enough to appease Elliott. We know Southwest has been a poor performer versus the group under Jordan. So I understand why Elliott believes that heads need to roll. Seems harsh, though. But there's plenty of room for improvement, and the board does feel a little parochial as it exists. But I want to contrast all of these situations at Starbucks with the situations at Starbucks and Nike. In the case of Starbucks, sales were terrible, even as other coffee shops were fairly robust. That made removing the CEO an easy call. Same with Nike, where the industry was robust and the old CEO had an ill-advised direct-to-consumer bent that just doesn't make much sense for expensive sneakers that really do need to be tried on. I think everyone should recognize the difference between these two kinds of situations. We may look back and think that Karen Lynch's job at CVS was just too hard. Same with Kenvue. The others? The activists mostly make a lot of sense, even as Southwest has already done a lot of the heavy lifting. At the end of the day, I'm always happy to see more accountability at the CEO level. More senior executives should lose their jobs over poor performance. But if you're a shareholder and you also want to make sure that they're firing the right people, it may not be the case. And if running a business is impossible for anybody, well, then maybe you just shouldn't own the stock anymore. I like to say, as always, bull market summer. I promise I'll find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.